What is a stock buyback and is it good for investors? Apple just spent $110 billion buying back its own stock instead of paying you dividends. Microsoft dropped $60 billion doing the same thing. So what the heck is actually happening with your money in your Roth IRA? And should you be worried? Stay with me because this answer might shock you. Alright, let's break this down simply. A stock buyback, also called a share repurchase, is when a company takes its own cash and buys back its shares from the stock market. Think of it like this. Imagine you own a pizza restaurant with 4 other partners. Each of you owns 20%. One day, you decide to buy back one partner's share using the restaurant's money. Now the 4 of you own 25% each without putting in any new cash. That's essentially what's happening here. Companies do this all the time. We're talking massive scale. In 2023 alone, S&P 500 companies spent over $800 billion on buybacks. That's not a typo. $800 billion. And it's been accelerating year after year. So why do companies do this? There are actually 3 main reasons. And some are better than others. Reason 1. Earnings per share manipulation. This is the sneaky one. Let's say a company makes $100 million in profit and has 100 million shares outstanding. That's $1 earnings per share. But if they buy back 20 million shares, suddenly that same $100 million is divided among 80 million shares. Now you've got $1.25 earnings per share without the company actually making more money. Wall Street loves this because it looks better on paper. Your stock price can go up even though nothing fundamentally improved at the company. Reason 2. Returning value to shareholders. Sometimes companies genuinely have excess cash they don't need to reinvest in the business. A mature tech company like Apple might generate $120 billion in cash annually but only need $30 billion for operations and innovation. A buyback can return that excess cash efficiently, especially when the stock is undervalued. Reason 3. Stock-based compensation. Here's what people don't talk about enough. Companies give executives and employees stock options as compensation. A buyback offsets the dilution from issuing those new shares. Without buybacks, your ownership percentage would shrink every time a CEO got a stock grant. Here's the real answer. It depends. And I mean that. The good news. First, if you're holding that stock in your 401k or Roth IRA, buybacks can actually benefit you. When executed well, they signal management confidence that the stock is undervalued. If a company's stock is trading at $50 and the CEO buys back shares at that price, they're essentially saying, "We think this is a steal." And historically, that's often been true. The stock appreciates, your portfolio grows, and you win. Apple started buybacks in 2014 when the stock was around $18. They've spent $110 billion since then. That stock is now trading near $200. If you owned Apple shares in your Fidelity account, this worked out incredibly well. Second, buybacks can be more tax efficient than dividends for long-term investors. You only pay capital gains taxes when you sell. With dividends, you pay taxes annually whether you sell or not. The bad news. But here's where it gets problematic. Many companies time buybacks terribly. They buy back stock when prices are high, right before earnings disappointments or market crashes. That's the opposite of smart investing. It's terrible capital allocation. Second, buybacks can be a sign of desperation or poor management. If a company is buying back stock instead of investing in innovation, hiring talent, or building new products, that's a red flag. Look at some legacy tech companies that spent billions on buybacks while younger competitors ate their lunch. Third, and this is crucial, buybacks funded by debt are genuinely dangerous. Some companies borrow money to buy back shares. That's like using a credit card to buy lottery tickets. It increases financial risk without creating real value. If you're investing in individual stocks through Robinhood or your brokerage account, don't make decisions based on buybacks alone. But do notice them. When a healthy company with strong fundamentals announces buybacks at reasonable prices, that's a positive signal. When a struggling company spends billions on buybacks to artificially prop up stock prices, that's a negative signal. For most of you, this doesn't matter much anyway. If you're investing in S&P 500 index funds through your 401k or Roth IRA, you own thousands of companies. Some have great buybacks. Some have terrible ones. The winners and losers cancel out over time. You'll still build wealth. The real wealth builder isn't obsessing over buybacks. It's consistently investing every single month, keeping fees low, and staying invested for decades. CTA